Welcome to the course on capital investment and financing decision. This course deals with the various kinds of financial decision that a manager undertakes throughout his career as a finance manager or director of finance. Today, we will be talking about the overview of these financial management decisions that are taken by the manager. Now, the financial management is not a decision that is to be taken alone. It is usually done in conjunction with other management colleagues, because finance as a discipline it correlates with all other disciplines such as production, such as marketing, such as HR. So a financial decision cannot be taken on a standalone basis. So the financial decision is always taken in conjunction with other management colleagues of an enterprise, and the finance manager is responsible for a whole gamut of activities. Now, among these activities, if we look at the entire activities that a finance manager does in his lifetime, all this activity can be logically grouped into three different categories, three different headings, such as the investment decision, the financial decision, and the dividend policy decision. Now, when we talk about running an enterprise, the first thing that comes to our mind is finance, like how to arrange finance and how to invest that fund in proper avenues so that we generate profit, and at the end of the day, what to do with the profit, whether to retain the profit or to distribute the profit. So the entire financial management decision runs through this three cycle of investment, financing, and profit allocation or the dividend decision. Now, when we talk about this investment, first we talk about, instead of financing, we talk about investment, simply because once investment happens, then only the enterprise comes into existence, and then subsequently we talk about finance. Now, when we talk about investment, the investment decisions could be of two types. Now, could be a long-term one, could be a short-term one. Now, what do we mean by a short-term or a long-term investment decision? Short-term investment decisions are the ones which give us the benefits. The benefits of this kind of a decision accrue over a short period of time, usually 1 year or so. Whereas when we talk about a long-term decision, the long-term investment decision is a financial decision where a huge amount of cash outlay happens, and the benefits of this accrue over a very long period of time, such as 20-25 years. Hence, these long-term investment decisions are very crucial, as you cannot afford to go wrong. So most of the times we say that these kind of decisions are irreversible by nature, because huge amount of cash investment happens in the beginning of the period, because you cannot once you are committed to invest in a certain area, you cannot go back, and there is a huge amount of risk involved. So these are the reasons why these are kind of irreversible kind of decisions. Now, when we talk about short-term investment decisions, these short-term investment decisions are basically these working capital decisions, and regarding which we are already discussing in another paper, that is the working capital management paper. That is a short-term investment decision. In this long-term investment decision, we basically, what do we decide? We decide regarding these long-term investment decisions are also otherwise known by the name of capital expenditure. So, or capex. So when we talk about capex, what are the focal points of decision making in this? The focal points are, what capex should the farm make, like whether you should invest in machine A or machine B, technology A or technology B, whether to set up a plant that caters to expansion thing or the diversification thing. So what kind of capex the farm needs to take. Then you talk about what should be the volume of funds they are committing to this kind of a project, and how these funds should be allocated among different investment opportunities, because fund as such is a scarce commodity. So when you're talking about investment of funds, we have to be very careful regarding how I'm going to allocate my funds. And when we have number of profitable investment proposals available, I might have 10 12 investment proposals available, but I might not have the fund available to arrange finances for all these 10 12 projects. So what I have to do is I have to decide which are the, suppose my funds are good enough for 3 to 4 projects. So I have to find out which of the 3 to 4 projects among these 10 to 12 projects available are the best ones. So, because I don't have finance available for all of them, so I have to decide on the most profitable investment opportunities that are available. Now, that is all about your, and there are several techniques of how this investment appraisal is done. So, we'll be reading more about these techniques in the subsequent chapters. Then we have the next big decision making, which is the how to arrange the finance. Now, having said that, we will be investing on a long term basis or a short term basis. Now, for example, if I say that my long term investment and short term investment for this particular year is going to run into hundreds of crores. So, the manager who is in charge of these things, he will obviously think about where to arrange these funds from. So once you decide where to arrange these funds from, the obvious choice is whether I'm going to avail it from one source or a multiple source. Now, it is obviously, as we understand, it cannot be such big amount of funds cannot be arranged from a single source. So we talk about a basket of sources from which we arrange. So this basket of sources could constitute ownership funds as well as loan funds. Now, you decide. This decision making basically involves deciding between whether I'm going for ownership funds or I'm going for loan funds, because ownership funds come with its own pros and cons, whereas the loan funds also have their own pros and cons. So I have to negotiate between the ownership fund and the loan fund, and I have to see how to strike a proper balance between these two, because if I'm heavily tilted towards ownership fund, certain kind of problems will arise. If I'm heavily tilted towards the loan fund, certain other kind of problems will arise. So I have to strike a balance between these two kinds of funds. Now, while deciding on this financing issue, the finance manager has to delve into various kinds of issues, such as I'm just giving you a few examples. What could be the issues that face the finance manager? Like, where from you are going to arrange the funds, and to what extent these funds are available from each of these particular sources. What should be the cost? Is the ownership fund cheap or the loan fund cheap? Now, what kind of financial instrument I'm using to raise this kind of fund? What will be the terms and conditions of this raising of finances? Whether the terms and conditions are liberal or whether they are very, very stringent. So these are some of the important focal points that the finance manager has to look at while deciding on the basket of financing. And then once now we have finances, we have invested in long-term and short-term assets. Now the company it has become a going concern. It is continuously producing things or services, and it is selling them to generate profit. Then the next question is, what do we do with the profit? Do we consume all the profit, or do we retain some of the profit for future use? So this kind of a decision is the dividend decision. Now this dividend, what does it decide? It decides basically about the allocation of these business profits or earnings between payment to shareholders and retained earnings. So how much is to be paid to the shareholders and how much of it is to be plowed back as retained earnings. That is a big decision making area. Because what happens is, A part of the profit that is distributed as to the shareholders as dividend has basically ends up being consumed, and the other part is retained. It is for the growth of the company. Now, if a shareholder doesn't consume the dividend, then again he has to think about reinvestment. So see, what happens is this growth and dividend. We desire dividend, at the same time we also desire that the company should grow, but they cannot go hand in hand. These are two conflicting goals. If I want dividend to consume dividend, the growth potential will be limited because the farm now has lesser amount of cash that it can invest in good projects so that it can grow. And if you want to grow, you will have to forego some amount of cash in the form of dividend. So these two are opposing kind of choices. So the finance manager has to balance between these opposing choices. Whether you want to consume dividend and settle for a slower growth rate, or do you want to go for a higher growth rate and forego of the dividend. Now, from the point of view of maximizing the shareholders' wealth, the finance manager obviously has to strike a satisfactory compromise between the two. Now, obviously, we all have to look after the investors' preferences, and there are several other factors while we decide on the dividend policy. For example, is there liquidity in the farm to pay dividend? Are the earnings that we are talking about from which we are distributing dividend, are they stable, or are they going to fluctuate in the future? If it is fluctuating, how do we give the dividend in the next years? We would decide that. Do you have enough cash available for payment of debt? Is there any restriction on payment of dividend? There are several restrictions put by through the covenants. Whether any other kind of restrictions. So you have to look after a lot of factors before you decide that I'm going to pay dividend or I'm going to retain dividend. Now, the basic essence of when we talk about the finance manager, whether he's doing all these activities, all these investment activity, the dividend activity, the financing activity, but the point is, why is he doing it? What is the goal he wants to achieve? What is the fiduciary objective of the finance manager? Because unless he has a goal or an objective, he doesn't know where he has to go. So what is the fiduciary objective of the finance manager? Now, when we talk about the objective, we are all operating in a very, very competitive environment. So the financial objective has to be set up in this competitive framework. And many times earlier during 1970s, it has been considered that probably maximizing the rupee income of the farmer, basically essentially saying the profit figure. If we maximize the profit figure or the rupee income of the farm, that should do. So finance managers in earlier times, they were driven by the profit maximization objective. Now, in the process of maximizing rupee income, it is automatically seen that the resources are very efficiently utilized, because if the given amount of resources inputs, if you produce more, if you're able to produce more with a given level of input, then obviously your profit will grow. So in your effort to grow the profit, you will utilize your resources very, very efficiently. It is also a very good measure for farm performance. Now, see, if we are measuring the performance of a farm, in the profit of the farm is continuously and gradually growing over a period of time, we'll have a tendency to think that the company is doing really good, for which the profit is gradually increasing over a period of time. And last, it also serves the interest of the society, because through a profitable venture, you can serve the interest of the society in a way where you produce desirable products and services for the society, as well as you generate employment. So it also, the profit maximization, it also serves the very interest of the society. However, with increased complexity of the business organizations, where there are several stakeholders now. Earlier it used to be entrepreneurship kind of a business, which was a simpler form of a business. Now that you have very, very complex organizations like public funds now, where there are a lot of stakeholders and whose interests oppose each other. So that kind of a scenario, it is very difficult to proceed along with the profit maximization objective. Now, why there are several objections raised against the profit maximization? It says that the concept of profit maximization itself is very vague. Now, what does it mean? It talks about what kind of a profit we're talking about. Are we talking about the operating profit maximizing, or we're talking about the gross profit, or we're talking about the net profit, or is there some other kind of a profit that we're talking about? Profit as such is an accounting concept. So, what profit are we talking about? It is vaguely defined. Again, the profit concept ignores the timing of return, because the suppose my point is, if I produce something at 20 rupee and sell it at 50 rupee, I get a 30 rupee profit. Now that 30 rupee, suppose I am able to sell it at 50 rupee and I am able to produce it at 20 rupees, so I have a 30 rupee profit. Now, if I increase over a period of time, if I increase my production activity, then probably with the mass production, this profit margin, the cost of production can be reduced from 20 to 15, and I can have the profit margin increased. But the whole issue is that this concept does not distinguish between whether I'm going to get the 30 rupee profit today or tomorrow. So it doesn't matter. Suppose if we talk about 30 rupee profit vis-a-vis 35 rupee profit. So the goal is to choose the 35 rupee profit, but it does not look at when the 35 rupee profit is happening. Suppose for the 5 rupee extra profit, if I have to spend 5 years, is it good enough that I choose the 35 rupee profit because it is more than 30? That is not answered. Again, it ignores risk. The concept of this profit maximization, it ignores risk, because when we talk about profit from project A or project B, project A could be an expansion project, project B could be a diversification project. Diversification has substantially more risk. But if we are talking about a similar kind of a profit figure, suppose both the projects have a profit figure of 10%, then we are indifferent between the two. Or for that matter, suppose the expansion project has a profit figure of 10%, whereas the diversification has a profit margin of, let us say, 11%. There is every tendency to choose the 11% profit margin. But then we are ignoring this, that 11% profit margin comes with a very, very high risk. That is ignored here. Then profit maximization assumes that there is a perfect competition going on and under which the profit maximization will work best. But whereas and in these days, because of the various stakeholders, opposing stakeholders, we consider the profit maximization as a very, very immoral objective, because it is considered to be unrealistic, it is difficult, it is inappropriate and immoral. So that is why we had to talk about some other kind of a figure to talk about the goal of the fiduciary objective or the goal of the financial management. Now, what is that other probability, other alternative of choosing the fiduciary objective? Now, this is a recent development where we say that instead of maximizing the profit pool, why don't we maximize the wealth? Now, when we talk about wealth, obviously I have to quantify what is wealth. Now, wealth is a recognized criterion which measures the performance of an enterprise. Now, how do we measure the wealth? By the way, when we talk about the measurement of wealth, we take into account a figure such as the net present value. Now, net present value, how do we compute the net? Now, suppose if I invest some amount of money in a project and the project gives me 5 years of cash flow. So, the comparison between the cash inflow and outflow, that after they being brought to a common time frame, the excess of cash inflow over the cash outflow is what is the concept of net present value about. That means I have the present value of the benefits, I have the present value of the cost. So when I compare the present value of the cost with the benefits, then we talk about the net present value. Obviously, when the benefits exceed the cost, we have wealth being generated, and when the cost is more than the benefit, then the wealth is being eroded. Now, the point is, when we talk about the wealth maximization, we talk about how we increase, how we expand this particular gap between the benefits and cost. Now, the as we you see from this equation, the profit maximization is a present value of all the benefits. Now, benefits I have shown in terms of A. Suppose n number of cash flows has been shown, cash inflows, these are all cash inflows. So where A1, A2, AN, such as these are the cash inflows or the benefits that are accruing to me over a period of time. And they are discounted by the respective case. For example, if I have an interest rate at which I am discounting, the first year cash flow will be discounted once, the second year cash flow will be discounted twice, and likewise. So the summation of this present value of these cash inflows, that is called as the gross present value. Now, from this gross present value, if I deduct the original investment or the original cash flow, which is ordinarily a cash outflow, if we deduct that, we get the net present value, so which is shown in the figure here. Now, having understood the objective of the financial manager, what should be the objective, we talk about the several cardinal principles of financial management which we have to follow. Number one is a strategic principle. Now, what is the strategic principle? The financial objective, decisions of a firm should be related to the overall corporate objective and strategies. It cannot be you cannot look at the financial decision as a standalone thing, because it is interrelated. So you have to see the financial management decision through the various other corporate strategies and objectives. Now, this next one is your optimization principle. Now, what will happen is we make extensive use of funds and other resources to ultimately generate the wealth. The job of the finance manager or the cardinal principle of the management is that all these resources should be optimally used. When I say optimally, I'm not talking about the maximum utilization. I'm talking about the just right kind of utilization. So it will be optimally used, the resources, so that the wealth will be generated. Now, the risk return principle, see what happens is you have to strike a balance between the risk and return in the crux of financial decision making. Now, what is this balance between the risk and return? Now, for example, you want to have more of cash in hand. Suppose I'm talking from the point of view of working capital management. If you want to have more of cash, you want to hold it in hand so that you want to pay your bill on time and as and when they arise. So your risk is very less, because you have a lot of cash, you can pay the bills and as and when they arise. So your risk is very, very low. At the same time, because you are holding cash, the cash itself does not generate any income. When you put it to work, it can generate some return for you. But when holding it in cash, it has become idle. Now, idle cash is something that doesn't generate any return at all. So when you are having more cash, your risk is low, but at the same time, the return is also very low because it doesn't generate any return. Similarly, if you have less cash, your risk is very high, but at the same time, the cash is not in your hand but is invested somewhere else, so it is generating the return. So either you settle for high risk and high return, or you settle for low risk and low return. But we as students of finance, we should look at how to optimize this particular balance of risk and return, how to have the lowest risk while trying to achieve the maximum return. Then we talk about the marginal principle. Now, according to this principle, the firm should continue to operate only to the point where its marginal revenue is just equivalent to its marginal cost. We should, under the suitability principle, we should create assets by financial instruments of the same approximate maturity. But for example, if you are talking about a machine which will give you benefits over a period of 20 years, you finance the machine through a long term loan. It is not wise to finance a machine which will give me a long term benefit through a short term loan. So it should be the suitability exam principle. Then you have the flexibility example where the financial plan of the farm should be capable of being changed to sync with the changing environment. That is, if now the capital markets are favoring equity, we should be able to change our financing plan. Now, if the market is favoring debt, we should be able to change our financing plan. And last is the timing principle. Now, the timing has to be crucial consideration for your financing decision. The investment and financing decision should be taken at a time that enables the organization to seize the market opportunities and minimize the cost of raising the funds. Now, for example, if the capital market is currently in an optimistic mood, it makes sense to raise equity because the equity raising cost will be lower in that case. But if the financial market is now pessimistic and is favoring debt, and we're trying to raise money through equity, then obviously it might not be the right kind of decision making. So the timing is also of utmost importance. So now we come to a very important aspect of time value of money, because see, in accounting when we talk about cash, we easily add up the cash of 1 year with the other year, and we can for purpose of computing we add up several years profit and then divide it by the number of years. So we can do that while we are talking about the accounting and the costing concept, we can do that. But when we're talking about financial management, this is not allowed. Now, because in financial management, we understand the concept that the investor has a particular preference for money. Now, what is that preference? That preference is called as a time preference. Now, this if I ask you whether I want to give you 10,000 rupees, whether you would take the 10,000 rupees from me today or after a month, I guess all of you will come up with the answer that you want to have the money today. Now, why do you want it? Because all of you have preference for money, that I should have the money right now. This is called the time preference for money. Now, that's okay that we all prefer the current consumption. But why do we want? What is the reason behind this time preference of money? The reason being, number one, is risk. Now, see, money that is in your hand today and money that is promised tomorrow, they are two different items, because money that is promised tomorrow comes with a certain degree of uncertainty. So you perceive some kind of a risk when you talk about future money. So, and you don't have that particular perception of risk when you are having money in your hand. So the every individual wants to avoid risk. So that is why he chooses current money over the future money. So there is a risk. Risk is the one of the reasons why the individuals prefer current money over future money. Again, consumption. Every individual loves consuming whatever they can buy with the money, because why do we like money is what money can do for us. I can use the money to buy certain things for me, and the process of buying and using the particular product is called consuming. So basically, when I'm consuming the money and doing something for myself, I feel very happy. I get a lot of satisfaction through that. Now, everybody wants to have the satisfaction as soon as possible. So, given the choice of spending 10,000 rupees today and after a week, I will prefer to spend the 10,000 rupees right now. Why? Because the consumption is a very, very pleasurable thing to the individual. So, he wants to have the pleasure right now. And the next thing why individuals have preference for money is the opportunities of investment that are available. Now, these if you suppose I asked you that whether you want the money today or after a month, all of you chose today. Now, why? Because today, if you take 10,000 rupees from me, probably you can invest in it in some place for a month, and after a month, you might generate a 500 rupee income on that 10,000 rupee. So, which you are not able to do when I give you 10,000 rupees after a month. So, the money has the opportunity of being invested elsewhere, and by the very act of investing elsewhere, I can generate some kind of a return over the money. So, that is why I always prefer the current money over the future money, because you have the investment opportunities available. Now, when we talk about obviously time adjustments, time value adjustments, I'm talking about a present cash over a future cash. Now, there are two kinds of adjustments possible. Number one, if I have a present cash and I want to know what will be the value of this particular cash in 5 years' time. So basically, I'm wanting to calculate what is the present value of the cash. I mean the future value of the cash. That kind of an adjustment of taking the cash from present and carrying to the point of 5 years later and computing the value there of is known as the future value calculation, and the process involved for calculating the future value is known by the name of compounding. This is a very common term, we hear it in our daily lives. Similarly, suppose your father promises to pay you certain amount of money when probably you are, let us say, 40-year-old. So you compute, suppose you are now 25-year-old. Now your father has promised to give you certain share of his wealth when you are 40. So which is 15 years now. Suppose that share of the wealth that your father has promised to you is, let us say, 25 lakh. Now you are going to receive 25 lakh in 15 years from now. Now you want to know what can that 25 lakh do for me today? That is, you want to know what should be the 25 lakh to be received 15 years from now. What is the value today of that particular amount? So this process of computing the present status of your cash, which you are going to receive in future, that particular process is known as the computation of present value. And the technique involved in calculation of the present value is the discounting. So you have two things, from present to future you compound, from future to present you discount. So these are two reciprocal processes. The compounding is the opposite of the discounting, and vice versa. Now we talk about the first thing, future value, because this is something that we have encountered in our daily life frequently. Now, when we compute the future value, what we do is, suppose the kind of problems that we deal here is, suppose I deposit some amount of money in a bank which promises to pay a certain interest rate. What should be the value of my money after a year, or after 2 years, or after 3 years? So this kind of problem, this kind of things we encounter in daily life. So the process of how we compute the value after 3 years or 2 years or 1 year, that process is known as the future value computation. And how we do it? We have the formula. So here we're talking about one single deposit, how it grows over a period of time. So the formula as shown here is the future value after a period of n years, which is I have written Fn, is equal to the principal or the present value that I am depositing today. The money I am depositing in the bank today is principal or the present value. So I have just written P for that. And it is multiplied with a factor of 1 plus I raised to the power of n. N is obviously the number of years. Now if I am depositing my money for 3 years, the value of n here is to be plugged in is 3. Now what is I? The I is the interest rate that the bank is giving me. Now suppose the bank promises an interest rate of 9% to me, then it should be 1 plus I is 9%. So obviously I cannot add a 1 with the percentage. So what I have to do is convert the percentage into a decimal. So this will be P into 1 plus 9 by 100 to the power n. So it is nothing but 9 by 100 is 0.09. So 9% converted into decimal figure is 0.09. So the bracketed figure now becomes 1.09. So P into 1.09 raised to the power n, that is 3. So if I have 10,000 rupees deposited in a bank, what I do is, what will be the value of 10,000 rupees after 3 years if the bank pays me a 9% interest per annum? So what do? You multiply 10,000 with 1.09 raised to the power 3. So first compute the value of 1.09 to the power 3, and whatever value you get, you bring it and multiply it with 10,000 rupees. So that should give you the present value, I mean future value of the your deposit. Now, to make life simpler, you have various tables available. This 1 plus I to the power n, this figure is known as the compound value factor. Now, you have several tables available for this CVF table, the compound value table. Now, this compound value table comes with, it's a table that the very frequently used by this for computation of policy premiums and all that. The insurance people use it very frequently. Now, the tables talk about the various combinations of I and n. What should be the value of 1 plus I to the power n for all combinations of I and n? The table gives you. For example, if you plug in the value of 5 and you plug in the 5 for I, 5%, and plug in the value of 7 for n, that is 7 years, and you look at the table, you look for the 5% row and the or 5% column in the 7-year row, the value that comes there is the value of 1 plus 5% to the power 7. That is the value that we get in the table. In fact, there is another very easy solution for this also, which is through Excel. You can go to the Excel and you can type is equal to, just implement, choose any cell and you type is equal to FV, future value. And once you type is equal to FV, an automatic syntax will be there to help you. And you follow the syntax available in the Excel, and you go on plugging the values as required as per the instruction of the computer. You go on plugging the values and then just click enter, so you get the value. So the point is, you have several methods of calculation. You can do it algebraically, you can do it very quickly by using the CVF table. You can also do it more quickly within a fraction of a second by doing it through Excel. Now, for example, this is a very simple case. If you deposit 55,650 in a bank, which is paying you 15% interest on a 10-year time deposit, how much would you deposit grow at the end of 10 years? Now, you can do it algebraically, but as you can see, 1.15 to the power 10 is quite a bit to calculate. So we have used the CVF here. Now, the CVF table, you look for the 10-year row or column, whatever is there in your table. You look for the 10-year row and you look for the 12%, so this is 15%, so 15% column, and the corresponding value is your value for the 1 plus I to the power n value. Pick that value and multiply with the principal, which is 55,650 here. So you get the final figure. Now, there is something called an annuity. Now, what is an annuity? Annuity is a series of cash flows which happen in equal installments and at regular intervals of time. Some very popular examples of annuity are salary, the housing rent, the LIC, the life insurance premiums, the EMIs, and all such kind of things. Any of these cash flows which happen at a very regular interval of time, maybe a month, maybe it happens every year, maybe it happens every week. If it happens in regular intervals of time and in equal installments, we call that an annuity. Now, the annuity could be of two types, the annuity due or regular annuity. Now, if you have an annuity that happens at the end of the period, for example, salary. We work for 30 days and then we get the salary. So this is the example of an annuity which is happening at the end of the period. So if it is happening at the end of the period, so we call it a regular annuity. Now, you could also have examples of annuity which is happening at the beginning of the period. That is, you pay an advance rent and then you avail the home. Whatever rent you are paying, the house you are taking on rent. So you first pay a month's rent in advance and then you stay. Again, 1 month completed, you pay another month rent, and then you pay. So when you talk about the advance payment, you are actually doing the cash flow in the beginning of the period. So that kind of an annuity is called the annuity due. Now, due annuity and regular annuity have only a gap of one period between them. The period could be 1 week, 1 month, or 1 year, depending on the nature of your cash flow. If it is a rent or salary, it could be month. If it's the premium payment, it could be a year, and likewise. However, what I want to highlight here is between the annuity due and the regular annuity, there is only a gap of one period. Now, if we bring the concept of annuity here, and what we do is, if I want to find out the series of a cash flow, suppose recurring deposit, I am depositing an equal amount of money in a post office savings bank, or in general recurring deposit in a bank. If I'm putting some amount of money every month in a recurring deposit, then what should be the value of that amount in 5 years time or 10 years time, whatever. And the point is, I am depositing a constant amount of money in my account every month. Suppose I'm depositing 5,000 every month in a recurring deposit. So which means I'm depositing 5,000 equal installment every month. So period is also same. So when I'm doing that, that is the example of a annuity. Now, how do I find out? Suppose I deposit it like this, and I go on depositing for 5 years. Now, at the end of 5 years, I want to know what is the value of my money. It's definitely not that if you see that for 4 years I'm depositing 5,000, so it works to 20,000. But actually, the value of your money has grown to, because we're depositing every year, it has grown to 21,873. So the additional 1,873 that we are getting is due to the compounding. Now we talk about the present value. Again, as we say that from present to future, the calculation involves compounding, and from future, if we want to bring it to current time frame, we call the process as present value computation through discounting. Now, present value of a future cash flow, how do we know? The process is known as discounting. The interest rate that we are using for the process of compounding can also be used for discounting. Now, again, what we see is here, please have a look at what I have done is the formula that I gave you in the present value, the same formula I have just changed, done a little bit of alteration and changed the sides. Now, what I have done is earlier my left hand side was future value. Now, what I have done is I have taken out the P or the principal or the present value to the left hand side, and the remaining things in the equation I have rearranged. Now, how it look like? It looks like P, that is the present value or principal or the amount or initial amount, whatever you can call it, that is equal to the future value into 1 plus I raised to the power minus n, which is nothing but 1 divided by 1 plus I raised to the power n, where n and I are all the same as we discussed earlier, I being the interest rate, n being the number of years after which the cash is to be received. Because we're receiving some cash after n years and we're trying to find out the value today. So n is the number of years after which we are receiving the cash. Now, you see, when we talk about future value, the 1 plus I to the power n, it is always more than 1. Yes, but when we talk about the present value factor, it is always less than 1, because we are discounting. Where 1 rupee received after 1 year, what is the value today? It has to be less than 1 rupee. So that is what we are doing. Again, in these tables are available, we can do it algebraically, and you can also do it through the use of table. Now the table goes by the name of present value factor table, PVF table. Now if you are looking for, you can find out the matrix where there is n and I, there is a crossover point. That value is the value for your PVF at n years I percentage. Pick that value and multiply with the future value and you get the present value. Now here as I have been telling you, that the same things you can also do through Excel. Now here I have given you the Excel formula also. You simply open your Excel, go to any cell, click on the cell and then write equal to PV. You just write is equal to PV and then your automatic prompt will come there. In the prompt will ask you to plug in the values of rate, NPER, which is the N period, then you have the PMT, periodic payment, and then you have the FV, the future value, and you have the type. Now in rate, what will you plug in? You will plug in the interest rate. And please keep it in mind, while you are plugging in the interest rate, you always have to put a sign of the percentage. 5, if you write 5, the computer will not understand. You have to write 5%. Then you have the N period. Now in N period, what you can do is you have to plug in the value of the number of years. 5 years, 10 years, 7 years, whatever year you are looking at, you plug in the value of that. Now, if you're talking about annuity, you plug in the value under PMT. If you're talking about a single cash flow, like you deposit in a bank, in after 5 years, what will be the value? That kind of figure, you have to put PMT as for a single cash flow, single deposit, you talk about PMT as being 0. So plug in 0. Now, if you have 5,000 deposited every month for 3 years, then you have PMT 3,000 or 5,000, whatever amount you're depositing. And then if it is PMT, then FV is 0. If there is no PMT is 0, then FV you will plug in the value, the single cash flow value, and type you ignore. It's not needed because, as I said, type 0 stands for due, 1 stands for regular. So even if you ignore that, it will compute the value for you. Now, the point is, in fact, you can use these Excel functions to compute anything else. If PV is not given, then you just can write down is equal to rate, another prompt will come. So you can find out any one of these unknown figures from the Excel. I urge you to go to the Excel and plug in some of these formulas to get a feel of how Excel solves the time value problem for you. Now a small case here. Now suppose you have an investor that wants to find out the present value of 50,000 he is to receive after 15 years. Now the banks are currently giving you a 9% interest. So what will be the value of the 50,000 rupees that he is going to receive in 15 years? Why I said you the value of and the interest rate is, now suppose you had the money right now, you could have invested at a 9% rate. Now, because you are going to receive it in 15 years, you are losing out on a 9% interest rate. So, we'll use that particular rate as the opportunity cost, using which we'll be discounting the cash flow. Now, you can use the algebraic form of the calculation. You can also use the table format, or you can also use the Excel format. And once you plug in these values, your present value of 50,000 that you are going to receive in 15 years. See, the value is a paltry amount of 13,750. So 50,000 it might look very handsome to receive in 15 years time, but today the value of that amount is 13,750. Of course, if your bank interest rate is anything other than 9%, if it is more than 9%, this value will be very, very less. If it is less than 9%, obviously this value will be a bit higher. So the discounting rate or the interest rate that banks are offering you is inversely proportional to the present value figure that we are computing here. And last one is your calculation of annuity. Now, like we did the future value of the annuity, we can also compute the present value of the annuity. Now, what will you do is, there is a slight change in the formula that we are undertaking, that the present value of an annuity is equal to A into 1 by I minus 1 divided by I into 1 plus I raised to the power n. Now this bracketed figure, the figure given in the bracket is the present value factor of the annuity, PVFA. So for solving this for various value combinations of values of I and n, you have the table available. The table is called the PVFA table. Now you refer to the PVFA table and you get the values that is given in the bracket, and you multiply that with the A figure. So you get the you get the present value figure of the annuity figure. In Excel, what you do is for calculation of annuity, you always use this PMT. You saw in the earlier thing, it was PMT was inside. Now PV, because PMT has become the unknown, now PV has become the dependent or the known figure here. So you just go to the Excel sheet, plug in, click a cell and plug in these values, that is plug in the formula that is equal to PMT, and then you will have a syntax like this, where you are asked to plug in the values of rate, the net period, the PV, the FB, and the time. Now many of the cases, the students are confused when they plug in the values, a negative figure throws up in Excel, because Excel doesn't understand cash inflow or outflow. So you have to make it understand whether you're talking about a cash inflow or outflow, because Excel understands that negative means outflow, positive means inflow. So you have to help Excel with this. See, when you have PV and FB together, one of them have to be inflow, one of them have to be outflow. It doesn't matter which one is inflow or outflow, but one of them has to be inflow, one of them has to be outflow, plus or minus. Only then you will get the result. If both of them are plus or both of them are minus, you will not get the result for PMT. Now, how do we have, I think I have a, yes. Now, this is a very classic case of the EMI calculation. Now, the present value of an annuity, what are the various uses that we have of these time value figures? Using the time value, we can solve a variety of problems. One of the problems is a problem of finding out how should be the EMI or the annual installments. What should be the annual installment? Now, I've gone for a very, very simple case. Now, suppose you have taken a 3-year loan of 10,000 rupees at 9%. And you want to repay this loan because it's a 3-year loan. You want to repay this loan in 3 installments. 3 end of the period repayments. Then what would you do? How do you calculate the repayments? That means you are going to pay out in 3 equal annual installments. How do you do it? You can do it by plugging in the values like the now here, because we already know the loan amount, so the PVA is known to me. The present value of the annuity, the left hand side, the present value of the annuity is known to me, which is 10,000. So I plug in the value of 10,000 on the left hand side. Then is equal to A is something that I'm trying to find out, because A is the amount that I'm going to repay every year. A is the annuity here. So that is what I'm trying to find out. Into, again, as per the formula, the bracketed figure goes by the name of present value factor of the annuity. Now, in the PVFA, what I have is I have 3 years. I have I, that is 9%. So I go to the PVFA table, find out the value for the 3 year and 9%, and get the value as 2.531. So pick up the value from there and multiply that with A. Now, as you see, A is equal to 10,000 by 2.531. That works out to 3,951, which means that to repay a 10,000 rupee loan in a period of 3 years by paying 9% interest, I will have to pay 3,951 rupee every year for 3 years to be able to repay the loan. This is a very useful application of the present of the time value problem. Another very useful application is like calculation of the period in which the money will be doubled. Many of the times when you talk about an investment, people have a tendency to ask you, tell me, in how many years my money will be doubled. I don't know what kind of a psychological significance the doubling of money has, but everybody is interested in doubling of money. So how do we solve that particular problem? You can write the formulation of present value or future value. Like here, the future value is twice the amount of the present value. So you write FV is equal to, instead of P, FV is equal to P into 1 plus I to the power N. Now FV you know is twice that of P. So you write it as 2P. 2P is equal to P into 1 plus I to the power N. So you solve for the N is what you want to find out. I, you know, certain rate of interest. You want to know in how many years your money will be doubled. So you can find out that way. There is a quick short formula for this also. The formula is called the rule of 72 or the rule of 69. So if you divide the interest rate with 72 divided by the interest rate, you get the approximate period in which your money will be doubled. So, and there are several other uses of these all these techniques of computing the present value from the future value, from the future value to the present value. You can do all these back calculations or forward calculations using the formulas. And I suggest that there are several problems given at the end of every textbook. Even in your material, also in the study material, you get a lot of small cases and the activities. I suggest that you go through each of them, and they will help you clarify your doubts. Please solve the self-assessment questions that will help you clarify the present value and the time value and the future value, all these problems. So, and the applications also you will learn from that. So my suggestion is that you go through the self-assessment questions and try to solve them. So because time value as such is very important concept, because it is going to be applied everywhere. Next, when we talk about the appraisal of investment projects, this is going to come in handy. So I suggest that you go through all the exercises. I guess so. With this, we come to the end of today's discussion. So to brush up, what we discussed today is we talked about the major finance decisions that the finance manager takes, like the three major finance decisions were investment, financing, and dividend. Under investment, what did we see? Investment is in two types: long term and short term. The long term goes by the name of the capex. The short term goes by the name of working capital management. So we are discussing working capital management in another paper, so that discussion doesn't appear here, though it is very much a part of the financial management. Then under capex, we saw that what kind of focus areas we should be having. Again, financing and the dividend, what should be the focal points. Then having understood the decisions that the finance manager takes, we talked about what should be the fiduciary goal of the organization. So going by that, we saw that the profit maximization as the objective was earlier working well. Nowadays, because of the complexity of the stakeholders and the relationship of stakeholders, the profit maximization may not serve as the best best tool. Rather, we talk about something called a wealth maximization through NPV. And then we saw the various cardinal principles that are to be followed while talking about the financial management. And now, just now we saw the why individuals have a preference, a time preference for money, and what are the reasons behind it, and what are the two kinds of adjustment techniques that we have. From present to future, we talk about compounding, and from future to present, we talk about discounting, and we saw various tools used in and the formula is used in the compounding as well as the discounting process. And as I told you, for both these processes of compounding and discounting, you can do it through calculators and through the use of algebra through calculators. You can do the same through the various tables available. All these tables are available in the Google. You just type time value tables. It will throw up a lot of table. You can download that and keep it for the ready reference. These tables are also available at the end of every textbook. You can use that for, these are very simple to use. You can do that. Alternatively, if you have access to Excel, nothing like it, Excel will solve these problems to you in a fraction of a second. So you have now the tools available, you have now the machineries available to do that. So use any of them, but I urge you that whatever you are doing, please once or twice do it through the Excel to give you a feel of the application of these things. So this much for today. We'll talk about the capex in the next class. Thank you.